In July of this year, many federal student loan borrowers will have to make the permanent decision to leave a plan called Pay As You Earn, or PAY, so that they can take advantage of the new rules governing an alternative option called Revised Pay As You Earn, or REPAY. In our last episode, we gave you some of the key terms associated with these income-driven repayment plans in general. And in this episode, we cover the current version of Pay As You Earn with the current version of REPAY, so you have a better understanding of what's at stake in this decision. Let's get started. Are your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt. Hello, my name is Brenton Harrison of Escape Student Loan Debt and your host for the Escape Student Loan Debt podcast. In our last episode, we talked about some of the glossary item terms associated with income-driven repayment plans, and I intentionally left the name of the two plans at issue out of the conversation. And as we get closer to July, when a decision between the two plans has to be made, we're building on that knowledge base and getting more specific. So what we're going to do today is we're going to compare the current version of Pay As You Earn with the current version of Revised Pay As You Earn. And to help us, we're going to bring back into the fold those key terms that we learned in the previous episode. I highly encourage you to take the literally 12 or so minutes of your time to go back one episode and learn those terms. And as I shared in that episode, we're going to be going through these things fast. If you're interested in that more detailed explanation, sign up for our email list at escapestudentloandebt.com so you can get more details on the course when available. Starting with eligibility. Pay As You Earn, or PAY, is only eligible to people who are considered new borrowers. And new borrowers is based on the date that you took your first student loan. For Pay As You Earn, you are considered a new borrower if you either did not take a loan or you had paid off all of your loans in full before October 1st, 2007. But that's not the only requirement. In addition to not having taken out a loan or having no loan balance by October 1st of 2007, you also must have taken a student loan after October 1st of 2011. Conversely, Revised Pay As You Earn has no limitations on eligibility. All federal student loan borrowers can make themselves eligible for repay, whereas with Pay As You Earn, there are two dates that can govern whether or not you can participate. Next, how are student loan payments calculated under this plan? They both require you to pay 10% of your discretionary income each year, and the calculation of that number is also the same. They both take your adjusted gross income and they subtract 150% of the federal poverty level in order to find that number. This calculation and this percentage, however, are really where the similarities between these two plans end. As an example, in the previous episode, we talked about something called the married filing separately exclusion. And what this means is, for certain married federal student loan borrowers, there are repayment plans that will allow them to exclude their spouse's income from the calculation of discretionary income. As an example, if I make $100,000 and my wife makes $100,000 and we have a young son, there are technically 3 people in our household. If we were filing our taxes married filing jointly, we would have a $200,000 income or so that would be used to calculate our discretionary income for 3 people in the household. However, if we file our taxes married filing separately, they would exclude my wife's income, and now only my $100,000 income would be calculated, but I can still include her as the third person in our household, which, as we've discussed federal poverty level, will help in lowering my student loan payment. Conversely, Revised Pay As You Earn has no such exclusion. Their income will be included in the DI calculation no matter what. The next difference between pay and repay lies in how long you have to repay your student loans before any remaining balances are forgiven. With Pay As You Earn, loans must be repaid for 20 years before any remaining balances are forgiven. But with repay, if you have undergraduate loans only, you have to pay those loans for 20 years as well. But if you have graduate school loans that are included in that basket that you've borrowed, your repayment period is extended 5 more years to 25 years rather than 20. And the last thing we'll cover before the break is the payment cap. Under these IDR plans, there is an annual requirement for you to do what's called recertifying your income, to tell them what you made in the previous year so they can recalculate your loan payment. In the last episode, I used reckless words, which I always try to make sure I avoid. I said that if they calculated this payment under pay as you earn and they found out that you would pay less by paying a 10-year standard plan, that they would kick you off of the plan and place you in the 10-year standard plan. That's reckless language because in actuality, you don't have to leave the plan to take the 10-year standard payment. If they do this calculation and find out that it would save you money, you can stay on pay as you earn and simply make the 10-year standard plan that would be required. This wrinkle that I'm mentioning will make more sense when I describe the consequences of going back and forth between IDR plans. With revised pay as you earn, there is no standard payment cap. Regardless of how high your payment will increase, they will keep you on that plan no matter what, because that 10-year cap is not a part of the calculation or consideration for repay. Now, by this point, you're probably looking at pay as you earn and repay and saying, why would someone who's eligible for both ever choose revised pay as you earn? There's no payment cap. I can't file married filing separately, and I could have to pay on that repay plan for 5 years longer than pay as you earn. But after the break, we'll tell you some more idiosyncrasies in how these plans work that can give some color to why people sometimes choose repay even when eligible for pay as you earn.
This is the Escape Student Loan Debt Podcast,
a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving home ownership.
We'll be right back.
Are you interested in learning the tools and techniques we use to get student loans forgiven, reduced, reorganized, or expedited? Well, great news. We're currently updating our flagship course, Escape Student Loan Debt, to reflect the current changes in the student loan landscape. To stay up to date on the launch of the course and opportunities to sit in on our live recording sessions, head to escapestudentloandebt.com and join our email list now.
You're listening to the Escape Student Loan Debt Podcast.
Subscribe now at escapestudentloandebt.com.
Welcome back.
Before the break, we gave you some of the details governing pay as you earn as compared to revised pay as you earn. And based on what we've discussed so far, you probably would be leaning towards the pay plan if eligible for both. But what I'm about to share with you now may change that perception in some scenarios because of something called an interest subsidy. As an example, if I owe $100,000 in student loans growing at 5% interest, that means that there's $5,000 of interest growing against that loan on a yearly basis. Let's say that instead of $5,000, I'm only paying $2,500 towards those loans each year. That means there's another $2,500 of interest that my payment didn't cover. And an interest subsidy comes to the rescue in this scenario by the government deciding to pay some of that remaining interest for you, but the amount that they pay is radically different depending upon the IDR plan that you choose. With the pay-as-you-earn plan, the subsidy of unpaid interest is 100% of the unpaid interest for 3 years only. However, after that third year, there is no subsidy regardless of your loan type under pay-as-you-earn. For revised pay-as-you-earn, they have a much more robust interest subsidy, and they determine that subsidy based on the type of loan that you have. For subsidized loans, the first 3 years of a repay plan subsidy are exactly the same as the pay-as-you-earn subsidy. They cover 100% of the unpaid interest for the first 3 years. For unsubsidized loans, however, they cover 50% of the unpaid interest for the first 3 years. But after that third year, the revised pay-as-you-earn interest subsidy starts to shine, because by this point, the pay subsidy will have ended. And under repay, they would have stopped paying 100% of the unpaid interest for those subsidized loans. But under this plan, from years 4 to 20 or 4 to 25, depending on how long you have to pay, they will still cover 50% of your unpaid interest. So for the entirety of the repayment period, there is some help if your payment is too small to cover the interest, whereas under pay-as-you-earn plan, that subsidy will have been gone for at least 17 years. Now, this isn't that big of a deal right now because for the time being, any remaining balances that are forgiven through these IDR plans are not taxable to you as income. So it really doesn't matter how much of your student loans are forgiven because there's no taxable impact to your finances. But that is due to expire in a few years. And once it does, if it does, it will go back to the old rules. And the old rules stated that when you have student loans forgiven under these plans, the amount that's forgiven is taxable as income in the year that it's received. So if I have $200,000 of student loans forgiven that year, it makes it look like I earned my salary and an additional $200,000 when I have to file taxes. That could lead to tens of thousands of dollars of extra taxes that I have to pay out of my pocket, meaning that the amount that's forgiven in these times is very relevant. And for some people, they look at the additional subsidy offered by Repay and they prefer that plan because it could lead to them having a smaller amount forgiven as compared to Pay, which could mean a smaller amount of taxes due if this legislation is to expire. And now that you have a cursory understanding of how interest works on these plans, we can bring this thing home with interest capitalization. We've covered in the previous episode that when you have student loan interest growing, it does not grow on top of your loan principal. Instead, they place that interest in a separate category, which means that when new interest accrues, it is always accruing off of the original loan principal. Interest capitalization is what occurs when, for whatever reason, that separate interest category is added onto the loan principal, and now in future years, interest will grow off the entire total instead of just the loan principal. So capitalization is something that you want to avoid if at all possible. With the Pay plan, there are some things that could lead to you seeing interest capitalizing on your loan balance. One of them would be if you're no longer eligible because you make too much money. Another would be if you stay on the plan but forget to recertify your income on an annual basis. If one of those things were to occur, you could see interest capitalization, but based on the rules of the plan, you would see that capitalization limited to 10% of your original loan balance. So if $100,000 of student loans is what you originally took out, it doesn't matter if there's another $100,000 of interest in that separate category. If you've remained on the plan, the maximum amount that could capitalize is 10% of that original balance. In this example, $10,000. However, if you leave the plan and just decide to do away with IDR plans or switch from Pay to another IDR plan, there is no limit in that scenario of how much can capitalize. With revised Pay as you earn, there's no cap in any scenario. If you forget to recertify your income and remain on revised Pay as you earn, you can still see 100% of your interest capitalized onto your loan balance. And if you leave the Repay plan altogether, just like with Pay, all of that interest will capitalize as well. So you not only want to make sure that you avoid capitalization while remaining on the plan, you also need to understand the consequences of switching back and forth between plans, which makes the decision coming in July even more consequential. So while in this episode we told you how revised Pay as you earn works in its current form, in the next episode we will finally tell you the changes coming to that plan so you can have all you need to know to make your decision.